Hey, good morning, good afternoon, guys. Hope we are good and hope we are enjoying the session. So today we'll do something a little new. That's the S&D SMC. That's the smart money traders, supply demand ICT traders way of reading the charts, like just how they see and how they read price, because that's what I learned very early in my beginner journey. So everything just starts with the trend. How do they read price? You see the same thing. The impulsive push, correction, impulse, correction, and impulse. So when you have two swing points, they are setting, okay, the trend is bullish. For the bearish market, the same thing, impulsive push, correction, impulse, correction, and impulse. You have swing points to the downsides. It gives them a sell structure. So this thing is basically what everybody, all traders do. But the average SMC trader has a way of naming the swing points. Do we get? So let's say you had this zone as the origin. You had 2 points here. So previously, the market was bullish, yeah? Let's say the market was bullish, impulse, correction, impulse, correction, impulse, correction. Good. So each impulsive push closing above a correction is called a break-up structure. Do we get? Like impulse, correction, impulse. Once the next impulsive push closes above the original last correction with a full candle, it's called a break-off structure. They term it BOS. BOS, break-off structure. Then when the candle rests, or what's it called, corrects again, goes and closes above the origin of the last correction again, that's another break of structure. Correction again, closes above, that's another break of structure. So they read price when price breaks to the upside as break of structures. Same for the bearish market. You have this impulsive push here, small correction, impulsive push, small correction, impulse correction, like that. So at the origin of each correction, there was the impulse, origin of each correction. Once price closes below, it's called a break-up structure. Same thing here. Same thing here. So they rate price in structure breaks, impulsive push, correction, impulse. So at the end of each corrections leg, once price goes up and closes below with a full candle, that is a break of structure. So let's go to the chart and see. Good. So if you see here now, okay, good. We have this, what was it called? We had a bullish market prior to now, impulse correction, impulse correction. Then now we have a selling market bar, impulsive push, correction, impulse go. So we have, okay, so we have this one now, impulsive push, correction, impulsive push, correction, good. Here again, the same thing. Okay, this one is much clearer. Let me change the chart, sorry. Let me look for a clean chart to explain this stuff for us. Okay, sorry. Forex.com. Okay. Yeah. Sorry. Good. So if you check here now, we had this impulsive. This thing is not so clear. I need a clearer. Okay, good. Let me clear. So you can see your downward market, upward, downward market, upward, downward market, Abi. So this was the origin. We had this push, and this was the last correction. Correction to the upside. So once market closes below here, the full candle, that's your break of structure. Market corrects again, breaks below this previous low. That's another break of structure there. Of structure there. Market corrects again above. This is another break of structure here. Market impulse again, correction, impulse closes below. This is another break of structure. Same thing here. Impulsive push. Close below the last correction. That's a break of structure. That's a break of structure there. Impulse again, correction, closes below. This one rejected. So it was this candle that closed below the last low. That's another break of structure there. That you represent with BOS or AB. Market goes up again. That's impulse, correction, and impulse again. Same thing. That's another break of structure. So that's how the SMC trader, the ICT trader, the supply and demand trader reads price. Let's check. Okay, good. You see here too. It was the last correction to the upside. Once the market closed below that last correction, it gave you a break of structure. VOS. That's it. Market came up again. Again, as impulsive push, broke below your correction impulse again. That's another VOS. So that's how the average SMC trader reads price. Here again, have a break of structure here. That's your break of structure. Market corrects again, closes below. That's another break of structure. The market comes up, closes below this last low again. That is another break of structure. So how do they name price? Impulsive push, correction, impulse. Once you have this correction, again, see where the correction started to where the next impulsive push started. That's your first break of structure. That's your first break of structure. Yes. And origin of the next correction again to the next, what's it called? The next impulsive push. That's your next break of structure. That's how the average ICT trader, SMC trader reads price. Same thing, impulse, correction, impulse, correction, impulse, correction, impulse. What do we see? Break below the last correction, break of structure, impulse again, correction rather, impulse, break below here. That's another break of structure. And break below here. That is another break of structure. So the next video will talk about how they map the tops of the correction, which they call inducement. Then the upper video will talk about how to trade it. All right, guys, stay put. Cheers.